Hello traders, James Stanley with StoneX and FOREX.com. In this video, I'm going to look at Fibonacci analysis specifically for trading and trading strategy. If you Google Fibonacci, you will find a plethora of resources that will talk about the in-depth mathematical concepts, the various ways that this is found in nature and the world around us, and in many cases it seems as though they almost ascribe a magical quality to it. That's not for this video. This video is specifically about trading and how it can help us as traders to find usable, workable levels of possible support or resistance. Support and resistance is important because that's what helps for risk outlay. You will never know the future in trading, especially if you're using just technical analysis or fundamental analysis, because at the end of the day, the past does not perfectly predict the future. But support and resistance can help to draw a line in the sand with which you can place stops, and then from that you could factor profit targets, and then that's where traders proficiently begin using strategy on the basis of analysis. But to get started, it's probably best to just go right to the chart and a real example. And I'm looking at the 5-year move in Eurodollar, and you'll notice that in the past 5 years there has been a significant high and a significant low that has not yet been taken out. The high in 2021 down to the low in 2022. And simply, I can add the Fibonacci retracement tool. I'm going to start at the beginning of the move. In this case, it's at the top because it's a downtrend. I'm going to end at the bottom of the move. And then that's going to automatically apply preset levels. So like, for instance, after that run, a 23.6% retracement of that move plotted at 102. Or a 618 retracement plots at 112.75. And to get started, let's just focus on that 618. In Fibonacci, it's 1.618 that is called the golden ratio, and that is what's found in several different manifestations of nature. And again, I'll allow you to do external study on that if you're interested in finding out more. For our purposes, it caught that low in 2023 really, really well. Again, the high in 2021 to the low in 2022, just very simple, defined major move with a high and a low that haven't yet been taken out. The 618 retracement at 112.75 caught the high in 23 perfectly. Now, if we look at this on a daily chart, this is what makes it even more attractive in my mind, because we had this aggressive, massive bullish move that just stopped on a dime at that 618 retracement. Now, if you're looking at this on a shorter term basis, like if you're a swing trader using the 4-hour chart, you'll notice that it played into an almost clean reversal of where we had that higher high right at 112.75, and then that's where the music stopped. And then sellers draw this down to a lower low, and then a lower high, and then they start to take control with another lower low, and lower high, and lower low, and lower high, and that sequencing continued. The advantage here is if you are able to see this level as it's coming into play in real time, you want to go from a bullish bias here to a bearish bias here. From trying to buy a higher low into selling a lower high. And identifying that line in the sand was key as to when that shift began to take place. And then, perhaps more importantly, if we do see bulls come back in, break through that level, then you know that the reversal that was possibly setting up isn't playing out. So you know where you're wrong. You know where you want to get out, thereby helping to set stop levels. That 618 retracement ended up coming back into play again earlier this year. It showed a support multiple times in April and then in early May. Notice that second test in early May leads into a lower high and then into a lower low. We even saw some resistance develop off of that level. But then after bulls responded here in late May, it was off to the races. Good illustration of that level being defended as support right there. Not quite a hammer formation, but it has similar tonalities of that, where you have the underside wick showing an intraday push below that price, which bulls rebuffed massively. That's just the 618 retracement. If we add the 38.2 retracement, we'll notice some similar movements. So the 38.2 retracement, another important Fibonacci level, you'll notice that caught the low here in April of last year. Again, almost perfectly. if we look at this on a 4-hour chart, you'll notice there was a dead drop of a sell-off right in here. A dead drop of a sell-off. Sellers were very much in control all the way until that price came into play. You'll notice they didn't go quietly either. We had the first test, and notice that underside wick. The underside wick shows bullish reaction. That's possible reversal. Sellers go for another test. This time they get down a little bit more, but same. Bulls come in, defend the level. We end up with support right at that same Fibonacci level. They go down again. This time another slightly lower low. So sellers are still trying to hit this, but buyers are coming in and starting to take on more and more and more of a role in the near-term price action. Notice here, now we have a higher low, and we have another one of those candlesticks. Again, it's not quite a hammer, but you notice the underside wick illustrating reaction with buyers taking over for the duration of that period. Now, even if you didn't want to strike on the higher low here, you got another test, and this time it's right at the Fibo level a couple days later, right at 106.11. And then that marked the higher low, and then we go on for a reversal. We can also add the 50% mark. 50% is not technically a Fibonacci level, but in my mind, if it's something that could help me find a resistance or an inflection point, then I at least want to see it. And I think a lot of other traders are the same way, and so 50% invariably finds its way on a lot of Fibonacci charts. But before that 38.2 test that we had last year, notice what comes in as resistance right at 109.43. Right in here. Right? Same deal. Bulls very much in control. They start to slip as soon as we get above that level. Then we get a lower high, then another lower high, and then bears take it away. We got the support play at 106.11, and then notice where resistance shows again, right at 109.43. This was July of 24. More recently, in the rally that we had this year, notice where this helped to hold resistance a couple of different times in March, before bulls were ultimately able to overcome that level. So the 50% mark, still of issue, still a valuable level to keep on the chart with Fibonacci retracement. Earlier this year, I wrote an article about Fibonacci and highlighted this level because as we came into 2025, Euro was just in a very poor state, and there was a lot of calls for parity. But lo and behold, in the first couple weeks of the year, support plays in right at the 23.6 retracement. Notice the way this played on the daily. Sellers, again, very much in control. They get down there Monday, January 13th. They tested below it briefly, and then price snaps back. That's a dragonfly doji. Not quite a hammer, but it has a similar underside wick showing that strong bullish reaction intra-period. Leads into a slingshot of a move up to 105. Now, this is something I'll cover in another video, but these psychological levels could also be of an assist. So again, just very simple Fibonacci analysis with a psychological level, helping in some cases finding confluence. But notice that we have the defense of that low with horizontal resistance, which essentially is making for an ascending triangle that led into a strong breakout in March. Right up to that 50% mark. And then up to the 618. Now, last most certainly not least, because these are levels that are in play right now, is the 764 and 786 retracement. Usually traders will follow one or the other, or charting packages will have a default of one or the other. I follow both because, again, if it can help me, it seems nonsensical not to follow it, or at least look for it. And these levels more recently have been coming into play as both resistance and support in Eurodollar. We saw resistance at the 786, support at the 764, again resistance, higher low, breakout, then support right at that 786. And then you'll notice this is where bulls are starting to lose their power because they rally off that support into a lower high, and then a lower low, lower high, lower low. And we've seen a continued test of support at this level throughout this week. So the jury's still out. It's still too early to say the bears are going to be able to break it down, but you'll notice that they're losing power on each of these corresponding pullbacks, as evidenced by these lower highs. That keeps the door open for a deeper pullback, a deeper retracement kind of theme. But for now, it's support until it's not. If we get a daily close below that level, it's going to start to look more attractive for a deeper pullback. But that, in a very simple run through, is Fibonacci analysis. It's not difficult to apply. You can look for those inflections, and again, at the most important point, it can help to find support and resistance, which can help to be applied for risk management and in turn trading strategy. And that's Fibonacci. Thank you.